All right, everybody, thank you for joining us for this edition of Thought in Action. I have David Taylor with me, my favorite nerd in the world. He's an attorney with the Taylor Foley law firm, 23 years of experience. I want him to talk a little bit about his firm first, and then we're going to dive into incentive stock option plans because I want to clear that up and talk about the benefits of that, a little bit about the costs, and then how people with a new company can really use those to let them shine. But before we get into that, David, explain a little bit about yourself and your firm so people can get to know your expertise.
Sure. Yeah, as you mentioned, 23 years in counting. It always amazes me to say that out loud. Always the youngest guy in the room, and now I'm not the youngest guy in the room anymore. So we're a transactional tax law firm, and a lot of people don't know what even a tax lawyer does or what it means. So I describe it as saying we put business deals together. In any sort of business environment and transaction, there are costs, which I refer to as friction or burn. The most substantial usually revolves around taxation, so we mitigate the tax bite of business transactions. Not only the tax bite, but our job is to make business deals more efficient, increase the yield to the parties.
Right. I was always told to be a specialist and not a generalist, and you're definitely a specialist in what you do.
Right. I can promise you there are a lot of things that I cannot do, and those I'm not a specialist in.
Well,
very broad.
One of the things that you're very adept at that I get questions on from time to time is the ISOP, these incentive stock option plans. And it amazes me how many different definitions people have of it. So can you just level the playing field, and let's just start with you explaining the basics of what it is,
Sure.
Just start there.
Love to. So an incentive stock option plan sounds sort of like a general description of a range of planning techniques, when in reality, that's a very specifically defined term in the Internal Revenue Code that is narrow in its application and the broader scope of planning techniques out there that I would characterize as key employee incentive plans, employee retention incentive plans, things that revolve around ownership interests for key people in your organization that can be conveyed and held in a tax savvy and otherwise savvy manner. We can start talking about incentive stock option plans, and then maybe I could put that into the overall context of general incentive and employee type plans.
Sure.
Sound good?
Yeah. So
Sure.
Let's start with why a startup would use an incentive stock option plan. What's the benefit to it to an early stage company?
With an incentive stock option plan, the word stock might actually give you a clue here. It's limited to corporations. Okay. Mm-hmm. So when you are talking about an incentive stock option plan for a startup, we're talking about it in the terms of a corporately taxed entity. All right. And incentive stock option plans, by definition under the code, are set up so that the employee or key person is granted an option to acquire the key person or a key employee. They're issued at a strike price equal to fair market value. Hence, there usually is no income tax consequences to the key person from the receipt of those options. The reason why a startup would be interested in an incentive stock option plan, most startups have a vision of growth and value. So price when the value of the company greatly exceeds its strike price. So that works perfectly with a startup because most startups anticipate large growth, and it allows key persons and key executives and ownership to enjoy an income recognition event down the line and have it taxed differently. So you're doing two things with the key person. You're giving them a right that will hopefully grow and explode in value that they can then harvest later. And when that harvesting occurs, it is taxed at capital gains rates if it's done properly and held for long enough, instead of ordinary income taxed, which is a much higher rate.
Right. So do you find that people typically set these up only in startups, or do they do this in any stage of company?
Any stage of companies. Yeah. Yeah, I mean, it depends on the size and the posture of the company and its growth cycle and its life cycle.
Mhm.
So they work very well with startups because of the growth factor of the organization, the expected growth factor. And startups mostly they're in need of of leadership. So it's good to attract quality people. It's good to align business and interest of the key person and the owners, because literally the key person is becoming an owner. So it aligns interest. It promotes good taxation. So there are a lot of positive elements in a startup that incentive stock option plans work very well with. With more mature companies, everyone probably hears about this and knows this from an executive level. It's a great way to compensate key executives and personnel that allow them to control when their income tax recognition event occurs and how it's taxed.
Right. So maybe this would be a good time to segue for a second and just talk about this in the context of a incentive plan in general.
Okay.
Just to contrast it, and then we can kind of go forward a little more on the ISOPs.
Sure. Well, incentive stock options, which is the defined term under the Internal Revenue Code, is an even more narrow version or subset of an already narrow silo of rules called qualified plans. And the word qualified here connotates that there's some sort of set of rules for these particular plans that are very objective. And if you meet those rules, you have benefits such as tax efficiencies. So an incentive stock option plan is a qualified plan. And there are others, and especially in the context of a corporate stock option plan, it is the particular plan. The other side of the railroad tracks, if you don't mind, is non-qualified plans. Non-qualified plans, almost by definition, include non-corporate entities like partnership tax entities, LLC taxes, partnerships, and the like. Equity funds, whatever. Non-corporate taxed entities are non-qualified plans. And the neat thing about non-qualified plans in the non-corporate world is you can replicate the same sort of tax results as you get with qualified plans and even incentive stock option plans. So, for your clients and viewers, anybody considering and watching us today, I would look at if you have a corporate entity, incentive stock option plans are one of the major players. If you're not a corporate entity, don't give up on incentive plans, because they're actually more flexible and greater options outside of the corporate world in the partnership tax arena and in similar arenas.
Gotcha. That's just side coming out. I like it. So what type of company, we talked about ideally suited to use these incentive stock option plans. Give me an idea though of like costs, timelines typically associated to set these up.
Sure.
People always say they're expensive or hard to put together. I never quite got mine finished. Can you debunk that a little for me and just say, hey, this is a typical cost, this is how long it takes?
Yeah. So typical costs, I would say to expect, and this is so relative. Take this for what it's worth, which is a very general comment, but you're probably looking at a floor minimum of about $30,000. One misperception there is it's a $30,000 check that you write day one. Design and implementation of an effective plan takes a little time. So it's a process over some periods of months, and that cost is spread out over that period of time. I certainly have seen them done for that amount. I've certainly seen them done for a lot more than that. It depends on the complexity, size, and sophistication of the plan. Okay. Timeline, I couldn't imagine instituting an effective plan in less than 2 months. I would say more often it's 4 to 6 months. Okay. Depends on the client, depends on the need. So who are the players that need to be involved? I know obviously your firm would be drawing something up, a tax lawyer, you could say, if they don't necessarily use you, but then who are the other people that need to be involved so that it's administered appropriately? Well, again, depends on the plan. So with incentive stock plans, specifically, you don't have as great of a need for a CPA, the internal CPA or tax advisors of the organization, as you do with non-qualified plans, but you still have that need. With non-qualified plans, having a good CPA or tax preparer on board, controller, CFO, is essential. So you also have your key executives. They need to have good counsel, not really legal so much as tax advisors. Sometimes that's a tax lawyer like us. Sometimes that's a good CPA, definitely. Your overall financial steward of your organization needs to be involved, because it is having a stock option plan impacts your corporate structure. It impacts your capitalization structure. Therefore, it impacts the ownership of the organization overall, usually for the better, for the positive. But you need to have some guidance and some stewardship for the financial planning of not only the current ownership, but the new owners.
Right.
Executives.
Now, is it flexible? Once it's set up, you can kind of plug and play. If you wanted to, if, let's say somebody left and you wanted to replace them, is it flexible that way, or is it something that once you set it up, you're committing to something and that's it?
No, it's pretty flexible. And again, it depends on the design. That question is a great segue for me to talk a little bit about some of the things that we do I think are unique and different. So let me give you an example. This is the lawyer nerd in me that you mentioned earlier. So we, I have this, my perception is that once you give legal title to an asset, to an individual, that individual, rightly so, has ownership rights in law that are vested, and they belong to them. You can restrict stock ownership based on the plan and based on the key executive, employee, or otherwise, but title vests in that person. And if you don't want that title to that particular equity sliver going away forever, then you have to figure out a way to restrict it. So one of the reasons why we like non-qualified plans, in addition to qualified plans, is we're able to have, and by the way, incentive stock options can also be held this way. But we like to, instead of giving title to the equity interest, the stock, or the partnership interest directly to the key executive, we'll actually have it held in a trust, an irrevocable trust, that the key employee and their family have all the rights and benefits of ownership except legal title. That actually provides the key executive a lot of benefits. It's asset protected. It's protected for domestic relations, for family law purposes. It's set up for estate planning to pass down generationally. There's income tax and estate tax, transfer tax efficiencies there. There's a lot of positives to the key employee. You can have a vesting schedule inside of that trust, which is really neat. But to the company, to the owners and the leadership of the company, the equity interest never leaves the company. It is held in this trust, and often the trustee of that trust is some member of the leadership, board of directors, or executive staff of the organization, the actual operating company. So you have sort of a both sides benefit result. And you talked about being able to plug and play. If I have one key executive, say my CEO, leave the organization, he or she, at that point, depending on whether they're vested or not, if they have the stock at their departure, it goes with them. But if part of my plan and part of my company and its growth cycle and its life cycle doesn't want that ownership to leave, having it held in an irrevocable trust can allow us to revert the ownership interest back to the organization to be given to the new CEO as a compensation piece. The actual equitable or the actual fair market value of that interest might leave with the former executive if it's vested. So he or she gets their money, but the ownership and the rights to control the ownership of the company stay within the company and go to the next person that's aligned for the organization's future.
Got it. Yeah. So those little nuances, I mean, I know this is going to be a silly question, but I'm going to ask anyway. People are like, why wouldn't I just set one of these up on LegalZoom or try to do it on the cheap? Like, these little nuances make big differences over time. Setting it up the right way gives you that kind of that ownership flexibility, but still puts the benefit in the ballpark of, the talent that you attract.
Yeah. I mean, to steal an analogy, there's some things that you would do. If you cut your arm, you might put a little Band-Aid on it or do something to close that wound. But you probably wouldn't open up your chest and perform some sort of medical procedure that requires someone who's well-versed in what's going on and how to make that successful. Right. The same thing, going and trying to do something this complex on your own, is not going to turn out well.
Right.
So, and having good one of the reasons why, one of your questions was, why would a startup company not do this? Uncertainty, frustration of not finding the talent out there like yourself that can suggest it and put it together. So finding the right advisors around you is a big deal. But once you find those people, being able to communicate the concepts clearly, it's not that complex. I want my people to be aligned with my interest. I want them to come to work every day and think like an owner. think about growth. I want them to rise with the tide as me and my family do.
Right.
And if they leave, that's fine. They can take that value, but I would like to have the next person have that same alignment. Once those key concepts are communicated, putting it together is the nerd stuff, conceptualizing why and how it works. It's not that hard.
Right. People typically don't like giving away ownership. I hear that a lot. Although I'll say in Los Angeles, when I would see all these startups, and even up in San Francisco, this is like one of the first things they would do is set up one of these plans to attract the people that they want to have on board. What typical for someone that's brand new thinking about this, what percentage ownership typically is carved off and put into these things?
Oh, like probably, I would say if you hit 20, you're starting to go into another stratosphere, like employee stock option plans and that sort of, which are a whole different animal. That's actually geared towards bailing out your ownership to retire to the employees. 20% is kind of high. 5% is about normal total. Depends on the number of employees. So a good average would be 5 to 10%.
5 to 10, and then it's tiered as the company grows, right?
Depends on the plan. Yeah,
right.
Yeah. I mean, it depends on the industry. I will say this, Eric. It's been after these years of practicing, one thing that stood out is companies that implement this strategy tend to be the ones that take off like rockets. Companies that don't tend to be the mom and pop shop that might go to generation 2, probably not to 3, but that's about it. So it's been proven out to be a wonderful resource to attract talent, to retain talent, and to grow the company because everybody's pulling in the same direction.
Right.
One of the situations where you might feel like you've given up something, but you've gotten so much more in return.
Right. We should have put that at the beginning of this. That's the plug. I'm like, how do I snip that part and put it at like minute 1? Because that's really, I think, the nugget that I wanted people to get is that I think about it, it's 5 to 10% ownership with performance, not without performance. And again, I know you can craft it all sorts of ways. $30,000 to get some really talented person or a group of people involved in a profitable venture. I mean, it doesn't seem like a wild trade-off to me.
You spend more than that on the upfit of your offices, multiples more than that. So investment in something that will return what that sort of planning will return is sort of a no-brainer.
Yeah. Where do you find the talent? I know that's probably the next question someone's going to ask me is like, I want to set this up. Where do I find these talented people? Do you have any ideas?
Yeah, I do. I mean, our clients are all over the country, as you know, really internationally. I find, at least in our market here in Charleston, South Carolina, we are attracting more and more talent. People want to live here, but we're attracting more and more talent because of our industry growth and the sophistication of our industries and capital structure, like we're talking about now. It's just growing in so many higher multiples than it was over the past few years. But I think at this day and age, we have the benefit of being a great place to live, great place to work, an organizational pool, and so I think getting those type of people to come from out of our market, or those qualified people to leave the positions in our market that they're in already, probably has everything to do with what you offer them. So if you are going to take someone from a successful company in another market or our market, one of the ways you're going to do that is to give them ownership. How are you going to give them ownership in a tax efficient manner that doesn't cause them a huge tax bill up front, which is the worst? And how are you going to make sure that they're aligned with your interest? And then when they're gone through death or whatever, your business, your organization can continue on with the next level of talent.
Right. Is there anything I'm missing? I mean, it seems pretty thorough to me. It's very straightforward. And I think this, from my conversations that I've had, smooths out a lot of those rough edges. Is there anything I'm missing that you think you should want to cover?
No, I think I can sort of reiterate what we've already talked about, which is they're a little, intimidating is not the right word. They're an unknown, right? I mean, how many people would know incentive stock option is a defined term under this really fun thing to read called the Internal Revenue Code? It can be a little intimidating. But again, that's just the technical side of things. Once you start to think about it in terms of what makes logical, rational sense from our organization, anybody probably can get behind. I'll give away 10% or 5% or whatever to make my 95% worth relatively 185% or 180%, right? Mm-hmm. And how do I do that in a way that everybody loves to come to work every day? I get the talent that I want. And even when they leave, my organization is still kind of at ground zero. What everybody can get behind that.
Right. Good deal. Well, this is super informative. I really appreciate your time. I really appreciate your background. It's awesome.
No. So everybody knows I'm a big Clemson fan, so I've got this Gamecock behind me. There's a whole story there.
I couldn't go the whole call without bringing it up.
Trust me, you won't be the only one. It'll be mentioned to me.
Yeah. Well, thank you again, man. I really appreciate it.
Thanks, Eric.
Yeah, talk to you soon.
Okay.